Hello and welcome to Market Call. I'm Mark Bunting in for Michael Hainsworth today. For the next hour, we have David Burrows, President and Chief Investment Strategist at Barometer Capital Management, and he's taking your questions on North American large caps. Here are the ways to reach us, so you can call us toll-free. There's the number. Send an email if you prefer, or tweet us at Market Call. Mr. Burrows, good to see you.
Great to be here.
As always, best of the season.
Best of the season to you too.
And all that. Now, those who have seen you before know that one of the ways that you like to invest is through big themes that you think are worthwhile. What are the? I know in the past, energy infrastructure has been an example. What's working for you now?
So for many years we've been very focused on the yield theme and dividend growth, which we think continues to be a very solid theme. But I would say that we've been taking our clients more toward the equity camp and more specifically into some groups that give us some different attributes. But we think equity markets look really positive going forwards. And when we look at where the leadership is, the leadership are all sectors that benefit from weaker inflation. So of course the consumer, but also sectors like healthcare, sectors like some of the industrials that are benefiting from the low energy costs in the U.S. And technology. And I think that we're seeing a slow, steady improvement in the underlying economy. And we want to focus in sectors where we can get multiple expansion going forward and benefit from some of the earnings growth I think we're going to see next year. So we're actually quite bullish.
As far as the markets themselves, do you think, especially in the U.S., are they just sort of digesting a lot of the big gains from this year right now?
Yeah, I think that if you look at the things that did well this last 18 months, they're more early cycle sectors that benefit from some of the low rates that we've seen. And I think that we've been consolidating. There's obvious concern, short-term concern around the potential taper. But ultimately, I think this is just a news item. I think that markets are behaving exceedingly well. Consolidation happens either in price or in time. What we've been seeing is sideways chop in the market over the last little bit. But I think ultimately the year finishes pretty well, and next year looks pretty good. You
kind of touched on it in your first answer in a way, but give us a sense of how you are shifting to more growth names from the yield side of things.
So if I went back a year ago, we owned a lot of interest rate proxies, things that do well just specifically because of interest rates. They're very stable, predictable assets like REITs, pipelines, telcos, things that had very low economic sensitivity. Over the course of the year, there's been a very clear rotation that's taken place away from things that with very high payout ratios to things that maybe pay a little bit less, but with higher dividend growth and distribution growth. And so some of the financials, some of the consumer discretionary companies. And I think that really where we want to be today are in companies that benefit from slowly improving conditions, that are more developed market focused, and sectors that benefit from falling inflation. A lot of the same sectors that did well in the 90s, in the last secular bull market. And arguably, I think that there is a case to be made that we are in a new secular bull market for equities that could go on for a long time. Valuations could, I think, rise a lot from here over the next few years.
So if you make a comparison to the 90s, are we in 96, 97, around then? Or
yeah, I think we're in a market that's very similar to the mid-90s. And when people make the reference to bubble talk, I mean, really PEs have expanded a very small amount. In the 90s, PEs expanded in 8 out of 10 years. Really, we've seen the first PE expansion since 2000 over the last 18 months. And I think as long as you think inflation remains muted, and in fact it's going lower, and as long as you think monetary policy is going to remain more or less intact, and I think there's every bit of evidence that it will, then that's good for the consumer. And so more consumer-related sectors are likely to continue to do well, which is more like the 90s.
All right, very good, David. The great table setter there. We'll take a short pause here and then get to your questions on North American large caps.